Welcome back to the channel, everyone. Today we're doing a truly deep dive, a full, long-form exploration into two of the most talked about ETFs in the high-yield options space, ULTY, the YieldMax Ultra Option Income Strategy ETF, and SLTY, the YieldMax Ultra Short Option Income Strategy ETF. These two funds are part of the growing Ultra lineup from YieldMax. And yet, even though they come from the same family, they couldn't be more different. One is designed primarily to generate income, sometimes eye-popping income. The other is engineered to generate income while benefiting from market declines. So naturally, a ton of investors ask, should I own ULTY? Should I own SLTY? Should I own both? Or neither? And that's exactly what this marathon video aims to answer. Over the next few minutes, we're breaking down why these ETFs exist, what their strategies actually do, how they use options, how each one performs in bull and bear markets, their distributions and return of capital risks, taxes, liquidity concerns, real community feedback from investors, and finally, which one might fit your personal portfolio strategy. If you watch this entire deep dive, you'll walk away knowing more about ULTY and SLTY than 99% of retail investors. Let's get into it. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. So let's start with context. YieldMax burst onto the scene with single ticker covered call ETFs, but the Ultra lineup is different. Instead of tying a fund to one ticker, like Tesla, Nvidia, or Apple, the Ultra funds hold 15 to 30 underlying equities. Why does this matter? Because the Ultra funds are built around implied volatility. They want to generate income from stocks that have high options premiums. YieldMax's idea is simple: high implied volatility equals high premium equals high distribution potential. The trade-off is equally simple: high volatility means high risk. The Ultra lineup tries to use options in a creative way to balance this equation. ULTY does that on the long side. SLTY does that on the inverse, short side. Understanding this foundation is key before diving deeper. Now let's talk about ULTY, the Ultra Option Income Strategy ETF. ULTY's core strategy is equivalent to holding a diversified basket of high volatility equities, and then writing covered calls against them. But ULTY is not a simple vanilla covered call ETF. Their team uses a mix of covered calls, cash secured puts, collar strategies, protective puts, even occasional credit call spreads. These components allow ULTY to continuously generate weekly income, manage some downside, and control the upside cap. Remember this key idea. ULTY is designed to produce income, a lot of it, but it cannot fully participate in big market rallies because call writing limits the upside. Then there's the distribution conversation. ULTY has often produced extremely high annualized distribution rates, sometimes 30% to 60% or more. But high distributions don't always equal high profits. Some of these distributions contain return of capital, which means you're effectively receiving part of your invested money back in the distribution. This doesn't automatically make ULTY bad. ROC can be tax efficient, but it must be understood. Next, let's talk risk. ULTY's biggest risk is simple. If the underlying basket of 15 to 30 stocks drops sharply in value, ULTY will drop with them, even with protective options. ULTY is not a bond. It's an equity ETF with volatility built into its core. So to summarize, great for income, moderate for upside, exposed to downside, some protection but not immunity, active management, not passive, high turnover, high expenses, high risk, high reward. If you want something that prints weekly income, ULTY is built for that purpose. But if you want long-term growth or deep bear market protection, ULTY alone won't give you that. Now let's talk about SLTY, the Ultra Short Option Income Strategy ETF. At first glance, SLTY seems like ULTY's opposite. And in some ways it is. SLTY gives investors an inverse exposure to a basket of high volatility equities. Meaning, if the underlying group of stocks goes down, SLTY can go up. SLTY then layers on short put writing, generating income the same way ALTI does, by selling options. But the direction is different. Think of SLTY like this: short exposure equals it benefits from declines, selling puts equals consistent premium income, buying calls equals caps catastrophic losses. Because SLTY sells puts, it will still generate weekly or monthly income, even though it has a bearish tilt. What does this mean? SLTY can potentially make money in two ways. A. Market goes down, short exposure helps. B. Market stays sideways, put premiums help. SLTY loses when the underlying basket rallies sharply. So unlike ALTI, which loses in sharp downturns, SLTY loses in sharp upturns. It's a mirror, but not a perfect inverse. This is crucial. SLTY is not a one-to-one inverse hedge for ALTI. They have different weightings, different timings, and different mechanics. Next, let's talk about distributions. SLTY has paid very high distributions, but many of those have included a very large return of capital percentage. That means the yield you see advertised may be partly your own money being returned. Again, not inherently bad, but important to understand. SLTY's biggest risks include short exposure risk, liquidity of option markets, counterparty risk, sharp upward market moves damaging NAV, volatility crush, reducing premiums. Think of SLTY as an income-generating bearish or defensive ETF, but one that can still lose money in both bull and volatile markets. SLTY is for tactical use. It's not a buy-and-forget product. It can be a hedge, an income stream, or a bet on volatility. But it is not a one-size-fits-all solution. Now let's put ALTI and SLTY in the ring together. Which one makes more income? Which one protects better? Which one is the right choice for you? Let's break it down. Income generation: ALTI tends to produce higher and more consistent income in most environments. SLTY may produce high income as well, but its short exposure makes performance more volatile. Market behavior: if markets go up, ALTI tends to do better. If markets go down, SLTY has the edge. Protection: SLTY is the protective ETF, but it's not perfect protection. It's more like a bearish, income-producing hedge. NAV stability: ALTI's NAV depends on long stock performance. SLTY's NAV depends on inverse performance. Both can decay in choppy periods. Investor use case: ALTI fits income-focused investors in neutral or bullish markets. SLTY fits tactical investors expecting volatility or declines. Some investors pair both in a 50-50 split, but community feedback shows mixed results. ALTI is not automatically good. SLTY is not automatically bad. They are tools. And tools require knowing when to use them. In this section, let's talk about what actual retail investors are saying. Many investors praise ALTI for its frequent weekly income. Some point out YieldMax made improvements mid-2025 by adding more protective positions, stabilizing NAV. Others warn that ALTI is not a substitute for index investing. They emphasize the high risks and the fact that distributions aren't guaranteed. Meanwhile, SLTY receives mixed feedback. Some investors love the idea of getting income while having downside exposure. Others complain that SLTY is not the simple hedge to ALTI they assumed. In general, ALTI has broader acceptance. SLTY is considered more experimental. Both attract income seekers. Both are considered high-risk income plays rather than long-term wealth builders. If you're considering either ETF, understanding this sentiment helps set expectations. Let's model some real-world scenarios. Scenario 1. Market rises 10%. ALTI benefits, but capped by call writing. SLTY likely loses value. Scenario 2. Market falls 10%. ALTI suffers a decline. SLTY likely gains value. Scenario 3. Market stays flat. ALTI collects premiums, mild gains. SLTY collects premiums, mild gains. Scenario 4. Volatility collapses. Both ULTY and SLTY generate less income. Scenario 5. Volatility spikes. Both generate more income but directional risk increases. This section helps investors visualize results before they allocate money. These ETFs have unique tax and risk considerations. Return of capital affects cost basis. Frequent distributions affect tax timing. Option strategies create turnover and expenses. Understand these before investing. Some investors hold these in tax-advantaged accounts specifically to avoid complications. Let's sum it up simply. ULTY pros: high income enhanced strategy, weekly distributions, long exposure. ULTY cons: downside risk, capped upside, high expenses. SLTY pros: income while being short, potential downturn protector, tactical hedge. SLTY cons: loses on rally, short exposure, volatility, high rock components. None is perfect. Each is purpose-built. If your primary goal is income, ULTY is the better choice. If your primary goal is downside protection while earning income, SLTY is the better tactical choice. If you want a hybrid strategy, income and hedge, you can blend both, but be cautious. And if you want long-term compound growth? Neither ETF is designed for that. Common questions include: is SLTY a perfect inverse hedge? No. Does ULTY guarantee income? No. Why are distributions so high? Mostly options premiums plus rock. Can NAV decay over time? Yes. Should you hold long term? Depends on your goals. The success of these funds depends on volatility, market direction, and investor appetite. If volatility remains elevated and markets remain choppy, both funds can thrive. If volatility collapses and markets trend, their results may weaken. Thanks for watching this full deep dive. If you made it this far, you're a serious investor looking to understand strategy, not just chase yield. Leave a comment below with which ETF you prefer and why. And subscribe if you want more deep dive breakdowns like this. See you in the next video.